The global semiconductor industry, the very bedrock of our digital economy, just experienced a significant tremor. With SK Hynix shares plunging over 11% and a wider tech rout spilling from the US into Asia, institutional capital is asking, is this merely a rotational blip, or does it signal a deeper structural repricing for the entire sector? We believe something fundamental is shifting. What exactly happened here? Asian semiconductor stocks tumbled across the board, directly tracking losses felt in US chipmakers. But this isn't just about a single company or a daily headline. It forces us to re-evaluate the core moats and value proposition of the entire semiconductor space. This sector doesn't just produce chips, it architects the future of AI, IoT, and electrification. The collective business model of leading chip companies, from fabless giants like NVIDIA and Qualcomm to foundry powerhouses like TSMC and equipment kingpins like ASML, relies on immense R&D intensity and exceptionally high barriers to entry. This intellectual property and manufacturing complexity are the deep asset insulation that typically protects margins. But even these moats face new tests. Here's where the sector's financial dynamics become critical. While we don't have individual quarterly reports for today's market signal, the broader semiconductor sector has recently seen a tug-of-war between strong AI-driven demand and cyclical pressures in other segments like consumer electronics and certain memory markets. This has created a bifurcated margin story. Aggregate sector revenues have shown resilience, particularly in high-performance computing. However, a mixed bag has been the common theme. Companies like Micron have navigated memory market cycles, while others like Intel face challenges in specific segments. The question for portfolio managers is, how sustainable is this demand, and what's the forward visibility on sector-wide revenue growth? Now, let's look at the collective management commentary from industry leaders. We're hearing consistent messaging about strategic capital allocation directed towards AI infrastructure and advanced packaging. Firms like TSMC are expanding capacity, and NVIDIA continues to push the envelope in AI accelerators. This isn't just about quarterly numbers, it's about a long-term execution strategy. The industry's capital expenditure plans remain robust, signaling confidence in future demand, but also potential for oversupply in some niches. We're seeing aggressive R&D investment across the board, targeting next-generation process nodes and novel chip architectures. This shows a commitment to structural momentum, even amidst current market jitters. That leads us to a bigger question regarding industry context. The macro environment for semiconductors is complex. On one hand, you have undeniable tailwinds from artificial intelligence and data proliferation. On the other, geopolitical tensions, particularly between the US and China, are creating significant headwinds and supply chain fragmentation. The competitive landscape remains intense. While NVIDIA dominates AI, Intel is fighting for market share in new areas, and Asian players like Samsung and SK Hynix are critical in memory. This dynamic ensures continuous innovation but also puts pressure on pricing and margin sustainability across different segments. Each segment has its own demand recovery timeline. Now, let's talk about the risks. The immediate market action highlights the systemic headwinds. Supply chain vulnerabilities, though improving, still exist. More critically, the cyclical nature of demand, particularly in memory, means oversupply can quickly lead to painful price compression. This isn't just about cost inflation, it's about demand volatility. Another major risk factor is regulatory pressure. Governments worldwide are increasingly focused on domestic chip production for national security, leading to subsidies and trade restrictions that can alter the competitive playing field. This policy tailwind for some can become a significant headwind for others, introducing new layers of uncertainty for institutional investors. What changes next? Despite the near-term volatility, the multi-year thesis for semiconductors remains robust, driven by the secular growth of AI, cloud computing, and pervasive digitalization. We anticipate a re-acceleration of demand recovery across more segments as inventory normalizes. Forward earnings visibility for the leaders in this space still looks promising. However, this recent market action triggers a valuation reassessment. Are current multiples fully accounting for geopolitical risks and potential for margin compression outside of high-growth AI segments? Institutional capital may begin repricing risk more aggressively, favoring companies with stronger balance sheets and more diversified revenue streams. That's where things get interesting. From a tactical perspective, we see certain segments of the semiconductor sector entering a trim consideration phase, particularly those sensitive to cyclical demand or exposed to acute geopolitical tensions. Conversely, highly innovative players with clear AI monetization pathways and strong intellectual property could be moving towards breakout watch territory as capital rotates towards structural growth at reasonable valuations. The takeaway for sophisticated investors is clear: don't get caught up in the daily noise. This isn't about panicking, it's about deeply understanding the structural shifts. The semiconductor sector remains foundational, but its insulation against macro pressures is being tested. We'll continue to track these shifts at SR Money News, bringing you institutional insights that matter. To stay ahead of these critical market developments, subscribe to SR Money News and join our community of elite investors. Your portfolio deserves this edge.